Now let us study Vega. Vega is most important Greek and it is god of volatility. As it is most important, it doesn't have any Greek notation, it is simply noted as V. Vega has highest power among all 5 Greeks. With power comes risk. So Vega has potential to create risk for our options positions. Vega measures change in option premium with 1 point change, which means 1% change in implied volatility of underlying asset. Implied volatility is current market behavior and it is based on crowd's mentality. So as crowd gets aggressive in selling or buying, implied volatility changes accordingly. Vega tells us what is effect of implied volatility on prices of option. It gives us effect of 1% change in implied volatility on option price. So if IV is 15% and suppose Vega is 2, then it means if implied volatility increases by 1%, option premiums will increase by 2 rupees. Now let us see how we can interpret Vega. Vega is associated with implied volatility. V for Vega, V for velocity, V for volatility. As implied volatility changes with dynamics of crowd expectations between calm mode and panic mode, the time value component or extrinsic value of option premium inflates or deflates. In calm mode, options become cheap, they are deflated, and in panic mode, options get inflated and costly. We have repeated this many times as it is very important aspect. Vega calculates the impact of these IV changes and helps to calculate new value of options if there is change in IV. Changes in implied volatility can have greater impact on premium of options. How much greater can it be? It can have effect more than combined effect of delta, gamma, theta and rho. For this reason, it is very important to apply volatility methodology properly and decide about optimal strategy to be used based on this analysis. Now let us see Vega correlation. What will happen to options means what will happen to puts and what will happen to calls prices when Vega increases. Can we get a volunteer for this discussion? Options are always positively correlated. Options are always positively correlated to changes in implied volatility. Means when implied volatility increases, Vega will increase. With increase in Vega, premiums of both calls as well as puts will increase. This is because of increase in extrinsic premiums. Vega affects only extrinsic value. It doesn't have any role in intrinsic value determination. This way, when we are buying options, we must buy only when IV is low. Implied volatility is in zone 1 or zone 2, then IV is low. Vega is positively correlated for buying option. Means with increase in Vega, premiums will increase, and with fall in IV, options premium will decrease by amount determined by Vega. So when IV is low at the time of option buying, increase in implied volatility and move in desired direction will give double benefit. Option prices will increase due to delta with move in underlying. This will add to intrinsic value when options are in the money, and price will also increase with increase in implied volatility. IV tends to go to mean. From zone 1 it will try to go to zone 3, and Vega effect will cause increased premiums. This phenomenon is good for option buyer. On the other hand, we must sell options when IV is high in zone 4 or zone 5. As Vega is positively correlated, when IV falls, option premiums will also fall simultaneously. So when IV is high at the time of option selling, decrease in IV will give benefit of decrease in extrinsic premiums. Even if underlying remains in the same area for few days and IV falls, there will be double benefit to option seller. How? Can anyone tell? One benefit will be due to theta decay and another will be because of IV fall. So high IV at the time of trade execution in options is good for sellers and low IV is good for option buyers. So as an option trader with this much of knowledge, whatever we have discussed till now, though we have not finished it full and we are going to discuss more, till now whatever has been covered, what would you like to do? How would you like to proceed about options? Would you like to be an option seller or an option buyer? With understanding of option Greeks, we will have preferred strategies for market conditions. We should not have biased strategy as per our mindset. Buying or selling depends upon market conditions. It does not depend upon how much money we have in our account. If money in account is main factor for decision making, then it is not trading. It is not a business, then it is gambling. Why? Because we are not following market conditions, we are not following basic rules. Now let us discuss Vega effect on expiry selected. What do you think about Vega? Where will it have more effect? Means, will it have more effect on near expiry or it will have more effect on far expiry? Can anyone answer this question? Greater the time to expiry, greater is time value. Greater the time value, greater is impact of changes in implied volatility. Lower the time value, lower is impact of changes in implied volatility. Therefore, greater the time to expiry, greater is effect of Vega, because time value is more in far expiry options. As per moneyness, where will be time value maximum? In the money, at the money or out of the money? Where will it be maximum? Time value is maximum for at the money options. So highest impact of Vega will be seen on at the money options or near at the money options. Deeper in the money options as well as deeper out of the money options have low time value, means they have low extrinsic premiums. Therefore, effect of Vega is less for deep in the money options and deep out of the money options. But why is it so? When option is deep in the money, there is small probability of it to end as out of the money option, and deeper out of the money options have small probability of expiring in the money. There are less chances of surprise in these strikes, hence effect of Vega is low on them. Vega has highest effect for at the money options and decreases up as well as down in option chain, means it decreases for in the money and out of the money. This way at the money options have highest impact of Vega. Let us see this example. Suppose there are three traders, trader A, B and C. They have taken one option buying trade at start of new series. Trader A has bought at the money calls for current weekly expiry with 5 days to expiry. Trader B has bought at the money call for monthly expiry with 30 days to expiry. And trader C has bought at the money calls for 3 months expiry with 90 days to expiry. Now underlying stays in buying area for next 4 days in consolidation phase, and then it starts moving as expected on upside. Vega also starts increasing as underlying starts its move. Which trader will get most benefit? Would anyone like to answer this question? Trader A will be crying by now or might have exited already, as theta must have taken out lot of premium, and even with up move there may be losses, or he might have exited already. Total percentage of premium lost will be big out of the invested premiums for trader A. Trader B might have some time decay, but it will be less than trader A, as expiry is monthly and it will be small percentage of total premiums present in option. But for trader C, what will be the equation? Trader C will have marginal loss on premiums by now as compared to both trader A and trader B, because theta decay will be very small and there will be large extrinsic value. As soon as moves start and implied volatility increases, what will happen to option premiums? They will start to increase, and maximum increase will be in the option with highest time to expiry. Is this logical and is this clear? Any doubts about this? Let's see this on graphical representation. Here we have plotted moneyness on y-axis and expiry on x-axis. These rhomboids show effect of Vega on option premiums. There are 3 expiries: current month, next month and far month. Top of rhomboid is out of the money, bottom is in the money and center is at the money. So these are the strikes: out of the money strikes, at the money strikes, in the money strikes. Central portion here we can see is widest. Here it is widest, here it is widest and here it is widest. What does this mean? This means for at the money options, effect of Vega is high, effect of Vega is large. At the money options are affected most by Vega, here also and here also. And deep in the money and deep out of the money options are affected least by Vega. Similarly, here we can see for current month effect of Vega is smaller than next month and effect of Vega is largest for far month. Remember these two statements and mark them down somewhere. Vega is highest in far month expiry and least in near month expiry, and Vega is highest for at the money strikes and least for away strikes. This is most important aspect of Vega. So if I have to look for an option with highest exposure to Vega, which option will have highest Vega exposure in terms of expiry and in terms of moneyness? Vega will have highest effect on this at the money option in far expiry. Knowing this is important for buyer as well as seller. Is that logical? Any doubts here? So for current month, Vega effect is small. For next month, Vega effect is more than current month, and highest Vega effect is seen in far month. Whereas theta effect is highest for current month, theta effect is intermediate for next month, and theta effect is least for far month. Theta helps option seller and is enemy of option buyer. So from this graphical representation, what do you understand? Where will theta have highest impact? This way theta has highest impact on at the money strike options, and it is more than in the money or out of the money strikes. Theta affects nearest expiry, Vega affects farthest expiry more. Both of them affect at the money. Okay, is this clear? Any doubts about this?